Hello and welcome to this video about how to invest in gold. So in this video, I'm going to show you how you can invest in the commodity on your trading account.
She take my money when I'm in need.
As well as that then, I'm going to show you the benefits and the costs that are associated with investing in gold. But firstly, the benefits are that if you're invested in gold, this acts as a hedge then against how stock markets perform. So we've seen in the last few months that stock markets have really taken a dive because of all the coronavirus fears out there, whereas gold on the other hand has completely rallied. And then if stock markets usually perform well, you will see that gold will not perform well as well. So they have an inverted relationship with each other. And this can really act as a good bolster to your portfolio in the event of a downturn. Because of that inverted relationship, you will have something performing strong there, which is gold, against your stocks which are performing poorly. Another benefit then of being invested in gold is it acts as a hedge against currency depreciations. So we've seen in the last couple of months that central banks have been printing a lot of cash and getting this out to consumers in the economy. And the reason they're doing this is that this cash will produce growth in the economy when the consumers go and spend it. So because there is more currency being depreciated there, you will see that investors are flocking into gold, and this promotes growth in the value of gold as well. But they are the two main reasons that you would see a benefit of being invested in gold. On the other side then, the disadvantages of being invested in it are firstly that it doesn't produce any dividends. So if you're invested in a company, that company can pay you dividends every year. So you're receiving some sort of cash flow or compensation for being invested in that business. Whereas gold on the other hand doesn't give you any compensation. You're purely just betting on the spot price of that commodity going up. As well as that then, gold is not like a business where it is generating cash flow for itself. So it doesn't have a range of products and services like some companies do, and they use these products and services to generate revenue. And finally then, gold is not growing every year. So it's not like a business where it can go and add to its workforce or it can expand into new geographical regions. And this would really be another downside with being invested in gold.
So here we are on the Trading 212 platform. For those of you who have watched my previous videos, you will know I'm a big fan of Trading 212. That's because it doesn't charge you any commissions when you buy or sell shares on the platform. So you can go then and use that commission money and invest it into your portfolio instead. And it will let you grow your net worth quicker if you are investing those proceeds instead of being charged a commission. For anybody who doesn't have a Trading 212 account set up, I have a link in the description below. If you click that link, you will get your first share for free on the platform. Just to be aware, I will also get a free share because I am an affiliate. So to invest in gold on the platform, what we do is we go up to the search bar here and we type in gold. So there are two primary ways that you can invest in gold. The first way is to invest in what's called a gold ETF. An ETF is an exchange traded fund, so that means it's a fund that trades on a stock market. Cash is pooled into this fund by investors, and then that cash is used to go and buy physical gold. So if we click onto the Ishares physical gold ETF here, one that I've used myself in the past, we can have a look and see how it has performed in the last couple of months. So since January, there's been a real rally in gold, and that's been due to the coronavirus. We can see that it was at £23 back then, and it's up around 26 at the moment, so about a 20% increase in the price there. It's really performed well when stock markets have decreased on the other hand, so good to have gold in your portfolio as a hedge. Then the second way to be able to invest in gold is to invest in individual mining stocks. Mining stocks are companies that extract gold, so they benefit a lot when the price of gold increases, and they usually see their share prices increase in line with that. So one mining company I've been following recently is Newmont. So Newmont is a mining company that trades on the New York Stock Exchange. If we click in here and have a look at the chart as well, we can see they're after performing in line with the spot price of gold and have increased about 20% as well since January. The risk here with investing into individual mining companies is if that company faces any sort of litigation or it's looking uncertain for them as a business, then you don't have any spreading of your risk if it's just into one company. Whereas if you're betting on the spot price of gold in an ETF, that's a lot better for your risk because you're just betting on that price as opposed to an individual company. On the other hand though, if you are invested in an individual mining company, a lot of them can pay dividends. So Newmont, for example, paid a dividend last year. So you are betting on the price of gold going up, but at the same time you're also receiving cash flow from that company. Whereas if you're in a gold ETF, you won't see any cash coming from that fund. You're purely just betting on the price of gold and that increasing. You can though pay yourself what is called a homemade dividend if you are in a gold ETF. So this would be, for example, if you had 10 shares in that ETF, if they increased in value and you sold off one of those 10 shares, you could use the proceeds from that then to pay yourself what is called a homemade dividend. So if we X out of here and go into Yahoo Finance, I have two different charts up here. So the blue chart shows you Newmont, the company we just looked at, and in the red chart shows you the S&P 500. And this chart I'm using just to show you the inverse relationship between how gold performs against how usual stocks perform. So Newmont, for example, was performing in line with the S&P 500 up until the start of February, and then since that there's been a divergence. So Newmont has gone on and performed very well. It's increased 14% in the last few months, whereas if you look at the S&P 500, it's down 17%. And why is there an inverse relationship between stocks then and between gold? And the reason is because when investors see an economic uncertainty, they like to flood into safe haven assets, the likes of bonds and gold. And since coronavirus has come around, you can really see here that investors have flooded into gold, and it's made the price of gold increase. Stocks then have really taken a dip, and that's because a lot of them aren't going to be able to be trading or getting the same amount of revenue that they would under the conditions of coronavirus. So it's very good to have gold in your portfolio, as it can bolster your portfolio in case there is a downturn in the market, and it gives you that hedge then if equities don't perform well. Hey, thanks for watching. Subscribe to my channel now to see more content like this in the future. See you soon.